Hi, this is Mike Maloney, and I just wanted to ask the really big question: have the stock markets topped, and has a crash already begun? And if it is a crash, how bad will it be? And here's some of the evidence that I was looking at. People refer to this graph here, I just generated this on the Federal Reserve's website, as the Buffett indicator. And it's an indicator whether the stock markets are overvalued or not. And it's simply the Wilshire 5000 full market cap index here, price index, divided by the GDP of the country, the gross domestic product. So how many goods and services, the value of all the goods and services produced in the United States over the period of a year. And what you see here, going back to about 1971 or 2, is that it was 80% the size of the economy, and the value of the stock market dropped to 40% the size of the economy throughout the late 70s and early 80s, and then started rising back up to 60% and then 80%, and then it became the same size as the economy, a ratio of 1. And then it was 120% of the economy. And up here in the year 2000, it almost hit 40% larger, where the value of the stock market was 40% greater than the value of everything produced in the United States over the period of a year, the GDP. And then with the stock market crash in 2000, the NASDAQ crash, the value of the stock market went back down to around 80, the same as it was back in 1970. Right here, a peak of about 1.05 times the size of the economy was the peak of the real estate bubble. And so the value of the stock market just exceeded the size of the economy by a little bit, by about 5%. And then went back down to 0.6 in the crash of the global financial crisis of 2008. And then the market rally that we have seen has it back up at about 120% of the size of the market. I was just reading an article from John Hussman, and he uses this indicator, the Buffett indicator, as an indicator as to whether or not what your returns are going to be over the coming 12-year period. And what he's discovered is that when you invert this chart, so this is that same chart inverted, it's a predictor that when this chart is low, when the stock market is very low compared to the size of the economy, the return that you're going to get on it over the next 12-year period is very high. When this chart is high compared to the size of the economy, the return that you're going to get on your investments in the stock market is very low. And so here is John, he inverted this chart. That's the reason I'm inverting it for you. Here is his chart with the market capitalization, this blue line here, market capitalization of non-financial equities compared to nominal GDP. And it's the logarithmic scale inverted. So over here is the inverted scale, 0.3, 0.5, 0.1. It's getting bigger as it goes down. And so the blue line is the one that we were looking at in the earlier chart. The Federal Reserve's data, though, only goes back to 1970, which is about here. So it incorporates this data, is what you saw in the last chart. And you saw it at first going down. Well, it's been inverted here, so it rises. But the astounding correlation is that the red line is the return that you got over the previous 12 years. So the red line stops 12 years ago, but the ratio of stock market capitalization to GDP has predicted very accurately with only a few divergences. Right here, it wasn't quite as accurate, and right here there's a divergence. It wasn't quite as accurate. But and in this area right here. But it's astounding how well this predicts future income from the stock market, your future returns. And this is over a period going back to 1925. So this is 91 years of data at this point. And but what I find is amazing is I'm trying to use this to predict whether or not the stock market is in a bubble. So I'm going to take his inverted chart and I'm going to invert that to put if you look up here, you've got actual subsequent S&P 500 nominal annual total return over the following 12-year period, and then market capitalization of, I'm dyslexic, so it's easy for me to read backwards sometimes and upside down, market capitalization of non-financial equities divided by nominal GDP. And that one was inverted. It's no longer inverted. Sorry for all the upside down dates and the upside down scales here. But what I'm paying attention to is the blue line here, which was that market capitalization to GDP, not the 12-year returns. And what you see here, that first chart, the reason I want to show you this chart is that first chart only went back to 1970. So it showed it falling and then rising and falling and rising and falling. So, but what I want to look at is how much time has it spent in these extraordinary levels where it is right now. Over the last 96 years, how much of the time has it spent in this area? According to this measurement, the stock market has only been in a super bubble just a few years out of there's like a year and a half there, and there's about a year there, and there's a year and a half here and a year and a half here. So you're talking about maybe 5 or 6 years that it's spent out of the last 96 in this super bubble territory. And the place it should be, the fair value, is probably this range in here. And then the time to buy stocks, the time to invest in the stock market, is when it's down in this extremely undervalued range. And you can see that we have not been down in this range since the early 80s. So we are in this extreme stock market bubble. All bubbles pop. We're probably going to visit severe undervaluation because these bubbles were so big. If you look at the super bubble of 1929, it visited the most undervalued that it has ever been, almost coming down to about 1/3 the size of the economy. Then the bubble of 1937, the valuations of the GDP, stock market capitalization to GDP, hit about 0.4, and it was at 40% of the economy in the 70s also. So this is another way of measuring the value of the stock market, whether it's in a bubble or not. This is data that I just downloaded from Professor Robert Schiller of Yale University. I've presented this many times over the years, tracking it and always updating it. I wish his chart didn't have the long-term interest rates, although it is interesting here that we're at the lowest interest rates ever, and we're still in this stock market bubble. When we had low interest rates in this period of time, it didn't correspond to extreme bubbles. It corresponded to a very undervalued area in the stock market. The last time that we had low interest rates with an extreme bubble was 1901. This is all part of something called the Kondratiev wave. And, you've got these major waves in interest rates, and in those you have roughly 2 cycles of stock market valuation extremes. What I want to show you here is they consider fair value in stocks to be about 13 to 15, or this range here, 13 to 15. So that's the fair value range. Under that is undervalued, and then anything below 7 is just extremely undervalued. Anything 13 to roughly 18 or 20 is considered overvalued. And then 20 and to about 25, this is a bubble. Then you get into extreme bubbles where it touched it in 1901, but there's been very few times in history that you have these extreme bubbles where where the PEs are over 25, meaning that the price of the stock is 25 times higher than the earnings that stock makes per share, the company's earnings. And then when you get over 30, you're in a hyperbubble. So we're in this extreme bubble territory right now when we're at 25.59. Extreme bubble territory. It always reverts to the mean. But look at how many years it's spent above a PE of 25. You've got about 4 years here and about 3 or 4 years here and a year or two there, and it just touched this for like a month here in 1901. So you've got the peak of the bubble in 1929. You've got the massive stock market bubble, the most overvalued in history, in the year 2000. But then, if you notice, we go from fair value, 15 and below, to this extreme bubble in 1901, and when it pops, it visits extreme undervaluation, valuations below 7. And then we go back into an extreme bubble in 29, a hyper bubble, and when it popped, extreme undervaluation, back into a bubble in 37. We came close to that extreme undervaluation, but we went severely undervalued. 1966, it was overvalued and went back down to extreme undervaluation. This time, however, when it popped from the most extreme bubble in history, it just went back down to fair value, this range of 13 to 15, and bounced back up into an extreme bubble. And that, to me, suggests that the stock markets have to fall. And they are going to visit their fair value. Before that, it's probably going to go to very severely undervalued, these ranges of below 7. So what has caused this latest bubble in the stock market? I've shown this chart many times. This is the Wilshire 5000 total market cap index, and the red line here is base money, base currency. So it's the monetary base is how many paper dollars exist, and back here, most of those paper dollars were in circulation, and very little was held as reserves at the banks. It also includes, base currency also includes the digital currency that is on deposit at the Federal Reserve as commercial bank reserves at the Federal Reserve. And so that's called excess reserves. And currency in circulation has continued to climb, and it's up here somewhere at about $1 trillion or so. I can't remember offhand. But the rest of it is all excess reserves that is on hand at the banks. And what you see is this startling correlation to where, the market was on its own back in the 90s, 2000s, 2005 here, and then you get the market crash and the global crisis of '08, and Ben Bernanke did the bailouts in QE1 and QE2 and QE3. Janet Yellen did this little tapering right here of QE3, and it went flat. And what you see is this astounding correlation where there is absolutely no possibility that this is a coincidence. It is the excess reserves at the bank that elevated the stock markets to these levels. So it's a total manipulation. And what you see is when Janet Yellen took the training wheels off, that the markets went along on their... So you take the training wheels off, and it's just like a little kid on a bicycle, goes along on his own for a little while until he crashes. And you see a head and shoulders top here, and the market is struggling. And what's really interesting, I'm going to zoom in on this. And so the initial bailouts in QE1 and QE2 and QE3, and the training wheels come off, and the market goes ahead and then crashes right down to base money. It gets up there again, crashes right back down to base money. It's up again, but we created something called a classic dome top. And when you look back in history, this is probably going to be the top of the market just before the greatest crash in history. That's where I believe that we are. And this is where I think it could go. So you have this dome that has built in the stock market. This is the S&P 500. So going back to 1996. So we've got 10 years, 20 years of data here, 30 years of data here, and then I've added a little bit of space because I just want to, I think that this is going to be the deflationary crash that I've been talking about, and I wanted to see where this could go. Well, in a deflation, a market can lose 80 to 90%. So there is the potential that we could see the S&P go from 18,000 to 1,800 or maybe 3,600. But even if they catch it at these trend lines, because there's a lot of traders that'll be looking at this, you're talking about below 6,000, from 1,800 to below 6,000. That's quite a crash. So another thing that I look at, this is again the monetary base and the Wilshire 5,000 total market cap index, and that astounding correlation, the training wheels coming off, and this classic dome top that is probably another peak in the stock market with a tremendous crash to follow. But the reason I show this is that there's two expansions that were like a year and a half or 2 years longer than the current expansion that we're in. And there was one that was like 6 or 9 months longer than the expansion that we're in. So before the end of this year, this economic expansion, the white area, these shaded areas are recessions, so economic contractions. Before the end of the year, this one will be as long as this one here. So that means that there's only two expansions out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 economic expansions since the year 1918. So, this is 98 years of data on this graph here, almost a century. And we're in the fourth longest economic expansion. It's going to become the third longest economic expansion in history. However, when a recession happens, it's always trailing data. They have to have 2 consecutive quarters of economic contraction to call it a recession. So by the time you find out you're in a recession, it's already 6 months old. We could already be in a recession, and maybe since just after this peak. And this crash, because it was all elevated with this economic manipulation, the free market is going to be releasing energy in the opposite direction. So I really do believe that this crash is going to take us down to levels that, it's going to be painful. It's going to hurt. And where does that pain end up politically? This is the Wilshire 5000, the first chart that we looked at, but with the recession bars on. So this is that Buffett indicator saying that we are in an extreme bubble. The stock market has only been bigger than the economy for just a few years out of the last century. And it's got to go back down here, but it's going to visit some extreme undervaluations. But like I said, politically, where does this lead? Because that's the scary part here. So the red line here is the Wilshire 5,000 total market cap index. The purple line is the government current tax receipts, the tax receipts of the federal government, so their tax income. And then the blue line is their federal expenditures. Now, there is other income besides taxes that the government has, so the deficit isn't the total amount between these two, but it's pretty close. So you've got a little bit of other income here. But regardless, when the stock market crashes, ever since the year 2000, tax revenues fall with it. If you look back here at the crash of 87, that was a huge crash, biggest one-day crash in history. It didn't affect tax revenues whatsoever. Recessions would affect tax revenues a little bit, but very little compared to what we have here when you get a stock market crash that goes along with a recession. Tax revenues fall with the stock market these days. And I call this the financialization of government. This time, when the stock market crashes, tax revenues are going to fall dramatically and deficits are going to explode. And the political pressure that happens during those periods of time lead to all sorts of acts and laws that are enacted and so on that lead to a change in the political landscape. So I think we're up for something. I think for most people it's going to be bad. For precious metals investors, the individual gains are probably going to be very good. But, what is the potential of how much more freedom are we going to lose? I mean, with this crisis, we passed the Patriot Act. And in this crisis, there was a whole bunch of changes in banking laws and so on. And all of those changes have done exactly the opposite of what everybody thinks they are supposed to do. With the Patriot Act, that was the most unpatriotic thing we've ever done, and we lost a lot of our freedom. We lost a whole lot of our freedom with all the reaction to the 2008 global financial crisis. What is going to happen next? I do not know. I don't look forward to the political changes. I do look forward to the gains that I believe that precious metals investors are going to realize. Anyway, that is the end of my ramblings for today. I hope you got something from it. Thank you very much.